Hello, my name is Dawit Kebede, Senior Economist at America's Credit Unions. Welcome to the Economic Update. Recently, the government announced that it will resume collections on student loans. This month, we will explore credit union members' student loan status and how this change may affect credit unions and their members. The federal government serves as the largest provider of student loans, accounting for over 90% of the $1.6 trillion in outstanding debt. In response to the pandemic, the government borrowers received relief through a combination of legislative and executive action. From May of 2020 through October of 2023, this temporary relief stopped interest from accumulating on student loans and reset all accounts to current status. This program had a significant impact. Approximately 80% of borrowers deferred their student loan payments either partially or fully. Following the end of the relief period, delinquency rates rose sharply beginning in January of this year. The 90-day plus delinquency rate reached 10% of total outstanding balances as of April 2025. This far exceeds its pre-pandemic level at around 6%. This sharp rise in delinquencies shows a significant shift in borrowers' payment behavior and highlights the challenges in resuming regular payments. The Department of Education resumed the collection process for defaulted student loans in May. The department's press release indicates the Office of the Federal Student Aid, or FSA, will tell borrowers what is next. Some options include requiring them to pay monthly payments, enrolling in an income-driven repayment plan, or signing up for loan rehabilitation. These required notices will come from FSA before they begin garnishing wages later this summer. This policy shift raises important questions. How many credit union members will this directly affect? What does this mean for credit union asset quality? To look for answers, we analyzed the Equifax analytic dataset, a 10% representative sample of U.S. consumer credit data. It is important to note that the numbers here reflect credit union members' individual student loan obligations and not credit unions' institutional student loan portfolios. Credit unions hold less than 1% of their portfolio as student loans. However, as of March 2025, 20% of credit union members have obtained these loans from other lenders. Collectively, these members hold over $430 billion in outstanding student loans, representing 26% of the national student loan debt. The distribution of the debt burden shows that nearly half of borrowers owe between $10,000 and $50,000. This graph shows a remarkably similar distribution of student loans by balance between credit union members and the overall student loan borrower population. This similarity also extends to bank customers, which suggests that borrowing patterns are consistent across different financial institutions. These members with student loans also hold $270 billion in different types of credit union loans, representing 16% of the total credit union loan balances as of March 2025. Auto loans account for 40% of credit union loans held by student loan borrowers, followed by first mortgage and other loan types. The loan distribution across credit score profiles reveal another important similarity between credit union members and other student loan borrowers. Non-prime borrowers account for 42% of outstanding balance in both groups. However, when examining the payment status of these loans, credit union members demonstrate slightly better performance. About 106,000 credit union members, representing $29 billion of the loans held by credit union members, are at least 90 days past due. Looking at broader student loan borrowers, there are about 245,000 individuals with $128 billion that are 90 days past due. These results indicate that credit unions' indirect exposure to risk due to the resumption of collections is slightly lower than other lenders' expectations. Complementary research conducted by academics at the University of Arizona and University of Connecticut explores the broader risk exposure facing credit unions, banks, and credit card companies. Their findings indicate that most consumers treated the pause in student loan payments as a financial windfall. with an increased utilization of credit cards and auto loans. Notably, credit union members' credit card balances grew 8.5% during this period. In comparison, banks and national credit card companies experienced growth rates between 25% and 30%. This suggests credit union members were more conservative in their credit expansion during the relief period. Also, credit union members typically obtain more favorable rates on auto loans, mortgages, and credit cards compared to borrowers at for-profit institutions. These lower rates result in reduced monthly payment obligations, which may serve as a mitigating factor against the financial impact of resumed student loan collections for credit union members. That will do it for this economic update. Thanks for watching, and we will see you next month.